There we go. All right, sweet. We're live. So, what's going on, everybody? We have a pretty special guest today. He's downplaying himself. When we were talking beforehand, he was downplaying himself a little bit. I don't think. Yeah, I think a lot of people that follow me, and a lot of people that I sort of deal with on the commodity side of things are really going to find tonight pretty interesting. We have Scott Scheimer on tonight. He is a loose relative of mine through marriage. My sister-in-law, what is it? Second cousins, I guess. You guys are
Yes.
cousins. Okay,
It's my
so
wife.
you're of your wife, yeah. So very distant. But Scott and I at the wedding, at my brother and sister-in-law's wedding, got to talking, and it turned out that we had really large commonplace with regard to the futures markets and specifically the commodities markets. So when Clarendon Alpha kicked up about a month and a half ago, I started, sort of building a platform that we could do some live shows. Obviously, you guys saw Charlie, hopped on 2 weeks ago with me. We're going to have a pretty cool lineup for September as well, both on the psychology side of things, but also on the trading side of things. And tonight, I kind of wanted to get on the trading side of things because we did, sort of have our psych session for August. And I'm going to let Scott sort of take it away here in a second. But Scott has about 15 years of experience, about 15, right? 15 years of experience, both as from a commercial standpoint and a little bit of a speculative standpoint as well. So just give us a little bit about your background, sort of what you did and what you're doing today.
Okay. I'm a production farmer in eastern Colorado. Main commodities is corn and wheat. I began farming 21 years ago, got involved with Cargill, Ag Horizons.
And to interrupt you right before you get to Cargill, when you started farming, was that through the family? Was that, how did you how did you choose that path, I guess, before you started getting linked up with Cargill?
It was my grandfather's farm.
Okay.
So it was in the family.
Cool.
And it was something I always had a passion for. Didn't grow up on the farm. Military kid, lived all over the world, but always came back to the farm in the summers.
Okay.
And so that became my passion. And when I was 10 years old, I set that goal, went to CSU in Colorado for ag economics, got my degree there. And unfortunately, my grandfather passed away my sophomore year there. And so I took over the farm and finished up school.
Wow. Okay.
So that's how, I started when I was 19 years old.
Wow.
So I guess awesome. That was 25 years ago.
Losing track a little bit. I like it.
So the industry has changed so much since I began. But then I got an opportunity to get involved with Cargill. Cargill was starting to make some changes in the ag industry. They weren't just a receiving facility of the commodity. They wanted to do a little more for the producers and get them involved in the futures markets in some manner. So they got groups of farmers within every state and had little committees, and they got together and discussed different things they could design to help farmers out using the futures. So they came up with products that gave them fancy names, using options and hedges, giving them little character names that they would just sell as a packaged product for a producer that would be delivering grain anyway, but got to take advantage of some of the prices above and beyond just a cash price delivered to the door. So that was my first involvement really with doing much with futures or even touching options. And so we helped design some of those products, and then Cargill launched those products 2 years later. And a couple years after that, I wasn't sure I wanted to be a farmer. Times were tough. The ag economy, we were in terrible drought, and opportunity came up to use my degree as a grain marketer for the Cargill facility where we live here. So I took that on, went out to promote these products to the farmers for them to bring their commodities to Cargill and put a value added on it. And did that for about a year and realized that I really do love farming way more than sitting at the desk. So
it's tough.
It's tough. It was tough to do both. And from there, I've probably used every product Cargill's ever had involved in the options or future hedges, and it is pretty much.
Was that just in ags, or did you have other products associated, with Cargill as well? Was it just wheat, corn, soybeans? What specific financial instruments were you using?
Specifically wheat and corn.
Okay.
Now, I would pay attention to soybeans because there's a correlation with corn. And then, of course, watching heating oil for our usage of our fuel. And natural gas. Almost all our chemicals and fertilizer are natural gas based. So we would kind of pay attention to that. But that correlation has disappeared in the last 6-7 years.
Really?
There's so few manufacturers of those products anymore, basically the fertilizer products.
Yeah.
That they now base their prices more on what the commodity market's doing. So if your corn's up high, fertilizer goes up.
Really?
Corn's
Okay.
Fertilizer goes down. There's zero correlation anymore with the natural gas market.
That's really interesting. And was there any particular reason as to why that correlation sort of fell off? Was it, or was it just they decided to track the actual commodity that they were fertilizing versus, the commodity that helped them fertilize, I guess would be the best way to put it.
Consolidation.
Okay.
Almost a oligopolistic market anymore. There's very few companies that manufacture the nitrogen sources for the U.S. So there's so few involved that they've got control of the markets. They don't have to follow. There's not enough competition.
Yeah.
So they're not following. They don't have to have that natural gas market to follow.
Okay.
Koch brothers is probably your number one.
Really? Okay. That's interesting.
Yeah.
That's really interesting. That's pretty cool. So with the you said you dealt with every financial product under the sun. With regard, what was like the most exotic thing that they had come up with? I from a fixed income standpoint, I see it just like random stuff always comes across my email, and I'm like, why would I do any of this? Why would I go into such an exotic product? From your standpoint, what was like the most exotic thing that you saw with, whether it be agriculture or whether it be, the energy commodities? What was that one thing where you're just like, what is this?
Okay, a product that I'm not sure I even have my mind wrapped around what Cargill. I'm sure it's just a buy and a sell of options. But in agriculture and farming, our crop insurance is subsidized by the government.
Okay.
And so Cargill said, all right, we know the time period the government tracks the market prices. The government tracks these prices to set a payment for the farmers for the following year. So during that time period, Cargill says, we will track that same pricing and give you a nickel to 10 cents above that price, guaranteed on your commodity.
Okay.
If you have a crop loss, the government's going to pay you, and we're going to give you an extra 10 cents. If you don't have a crop loss, you're still 10 cents above what the guarantee is from the government on your insurance on your crop loss.
Interesting. Okay.
I don't know.
I was going to say, it sounds like a lose-lose to me. Yeah. That's interesting.
So all farmers, we get some sort of insurance coverage. We're required to get insurance coverage, and we can select from a menu. But of that menu, we can select percentages and what our yield potential is. The government has a set price. So they're going to say next year's corn crop, let's just use for an example, will be $3.38 a bushel. So if a farmer has a crop loss, drought, flood, they will pay him on his guaranteed bushels, what he typically produces. They will pay him $3.38. So Cargill's turning around saying, hey, we want you to still contract with us. You might not bring us the commodity because of the drought, whatever, but we want to guarantee that if you don't bring us a commodity, we're still going to have you in the market above your insurance. Because if you get yourself below, you might have to write a check back to the elevator because you couldn't deliver the commodity.
Yeah.
That would be your margin return.
Okay. That's interesting. That's really cool. That's really neat. I mean, just the amount of innovation. I know we'll get into this sort of later. It's like the last topic to cover tonight, but just sort. And I know you even mentioned it. The industry has changed so much from when you first started. When you first started, did you even use any, financial instruments to sort of hedge your inventory, or if it was a bad crop year, it was just a bad crop year, like there was nothing about it?
None whatsoever. It was probably 6 or 7 years. And to back up on that, I could say just in our region, I covered one of the largest territories as a grain marketer for Cargill. My territory was one of the largest in the nation. And I would say less than 10% of the producers I worked with did any kind of forward hedging at all.
Really? Really?
And
wow.
To this day, there's probably 15% that will use what I call the mutual fund of products, a very simple, easy market tracking product. Probably 5% use any kind of option tools.
Wow. So is there a little bit of an opportunity for farmers to sort of take advantage of these kind of products? I mean, it sounds like there's they're not sort of utilizing these products as they should be utilized. Is it because of what's going on with sort of the landscape right now, or is it primarily that they don't really want to get into that game? They're not, they're like you said, you realize that you didn't want to sit at a desk. You want to be a farmer. Did they are they realizing they don't want to just get into that at all, or is it just a sort of, the market's just not right to sort of position themselves right now?
I believe what happened is actually the market prior to now.
Okay.
Was at a point, I mean, we had really nice high corn prices, high wheat prices. A lot of money was being made without having to worry much about your margin, your bottom line. Now, with low commodity prices, the strength of the dollar, limited exports, and input costs are still significant. Machinery costs. If you see interest rates start to make any kind of move up, this dynamic, actually, guys, are going to have to be very careful because the margin return is much tighter in agriculture, and I think a lot more of them are going to have to take advantage of these. Currently, cash prices delivered to the elevators here, the receiving facilities, is below break even for guys.
Really?
On their operation, and it's it's bad. It's tough.
Yeah,
it's tough. I guess the perspective you got to take is that farming, you're not making tennis shoes every week. With farming, you prep the ground a year ago to get this year's crop in.
Yeah.
You were spending last year's money, last year's input costs, high petroleum prices to get this year's crop.
Yeah.
And if these prices are down now, you didn't profit off of what you put into your crop.
Yeah. Well, I guess my question now, and this is sort of, so I did a little research a while back on, understanding the supply chain management with companies in the coffee industry. So Dunkin' and Starbucks were the two companies that I looked at. Starbucks does all of their own supply chain management. Dunkin' actually outsources their supply chain management to a separate, I guess you could call it sort of a sub-entity of the company. But they're affiliated with Dunkin' from the standpoint of Dunkin' owns 85% of them, but they're not a fully owned subsidiary type thing. And they don't have to worry about that supply chain management at all. They just have to focus on that one thing, and that's selling Dunkin' products. Starbucks, on the other hand, has about a year and a quarter that they push out to start, sort of hedging themselves along the coffee curve. Do you see that because prices are so low now that there is opportunity to sort of take advantage of locking in prices maybe 2 years out or 3 years out with the way that the curve sort of is right now on corn and wheat and whatnot?
Right now, I think wheat and corn, my personal perspective is we're rock bottom on these markets.
Really? Okay.
I think you've got a 95% upside, a 5% downside.
Wow. Okay.
Everything It's no different than any market. Every negative piece of news has been thrown at this deal over and over. Right now, with the strength of the dollar, exports are just shut down. In fact, we ship milo, also known as grain sorghum,
Yep.
which is traded on the corn board. We ship it to China. They're our biggest buyer, and we ship it down to the Gulf of Mexico. The Gulf typically has a bid of about $1 over the board price. They went to 50 cents under 2 weeks ago. They're not even making offers today on milo.
Okay.
So there's no offers. So their commodities are not going to be moving.
Wow.
It's all negative right now. I just feel like there's not much more you can throw at this deal. I think there's a lot of upside potential, especially in the corn market. USDA just reported their production numbers. There's a lot of private analysts out there saying there's no way we're going to have as big a corn crop as the USDA is saying. And
Really?
the charts are showing that. They didn't have a huge reaction after the USDA report. We're still bouncing across the bottom, but I think there's a lot of upside potential in this.
So I know that we sort of talked about it a little bit, last week as well, with regard to your upside call, or I guess your downside call really with oil as well, and how you said, you sort of spoken to a couple people regarding, what's going on in the energy markets, and they see continued downside. What's their sort of perspective with that? Sort of moving forward. Why are they seeing a continued downside? We've already taken this hit from a market that, of course, was overvalued at that 100, high 90, low 100 spot. But do they really see it continuing to tumble? Is that supply and demand picture so hard that we could see $30 or even $25 a barrel?
I think OPEC's announcement that they're willing to produce under sub 30 has really hurt that. U.S. production, we have oil in our area. Even some of my neighbors are drillers or they work on the sites.
Yeah.
They're telling me even the production we have here that's existed for 20 years, it's slowed up tremendously, but they're still producing. Even at these price levels, they can still pump out a little oil. It's, you get down to this $30, $28. These guys, there won't be much exploration. When will it recover? How long will it take to get the pipelines up and filled again? I don't know. But the consensus around here from the guys that have much more in the field experience feel like this is a 2 to 3 year trend. I did see an interesting chart that showed that our petroleum supply compared to our consumption, the spread is the greatest we've ever had in the history of our country.
Really?
And that was a presentation Cargill put on here about a month ago, just showing the supply and consumption in. It was quite a spread. It looked like it was going to take quite a while for those lines to come back together.
That's nuts.
It's nuts. Scary.
It is, yeah, it definitely is. Oh, it definitely is. So I'm actually, speaking of charts, I'm going to bring this one up. This is over the last 10, it's showing 5. It's showing from now, which is down here, all the way to, we get to capture that beautiful moment in the middle of July in 2008, before we, saw a complete price collapse. And we're starting to really get near those prices again. We're $6.20 off of that, where we are now from the low of 2000 and, the beginning of 2009. We really didn't have much of a recovery here. And I saw a couple of, my technical analyst buddies that said, this is sort of a dead pattern. We didn't really do much here, and then we sort of rolled over. And it's neat if you overlaid, talking a little bit about emerging markets. If you overlaid an emerging market, chart over this, you'd see that, emerging markets didn't really do much during this time period either. You know, in oil, we were staying in between this $110 to $80 range, you know, for about 2 or 3 years, almost 4 years. And, you know, then we, you know, when we shit the bed, you know, we sort of saw those, you know, those emerging markets also shit the bed. And I think that that's sort of, you know, what you were talking about with, you know, what's going on overseas and how demand and supply has sort of really been impacted by that. You know, do you see a lot of the international picture right now, what's going on in China and what's going on, you know, in other emerging economies? Do you see that really making an impact, you know, pushing out 2 or 3 years? Do you see price recovery coming back in your markets? I know we sort of touched upon it a little bit already, but from an international perspective, do you think that this plays a much larger role than most people think it is, or do you think it's, you know, sort of a little bit of an exaggerated move right now?
I think it's an overreaction.
Okay.
I think, and this isn't all specifically my bias. I hire 3 different commodity marketing services to give me their analysis, both technical and fundamental, to help me make a decision. And when they all stand on the same position, that's when I'll pull the trigger on my moves. And they all feel we're bumping bottom in this commodity end, specifically food product commodities.
Mm-hmm.
The world's still got to eat. Middle class is still growing. Economies still are growing. China and Japan are probably 2 of our largest consumers of U.S. commodities, such as soybeans, corn, wheat. Egypt's a big buyer of our wheat. And the world's still got to eat, and they feel like they'll still be consuming these products. And it's going to be a slow growth, though.
Yeah.
The long-term outlook looks 3 to 4 years. There's a lot of buzz going on the commodity end that agriculture is going to be king in the industry, whether we see it or not.
Really? Okay.
A lot of the discussion is you look at world economies growing. Eventually they will. And it's economics 101. The consumer demands a higher-end product, going from pork, poultry to beef, going from rice to wheat, breads. And they just feel like we faced – I'm going to back up. We faced this glitch in 07. The whole world had a little bit of trouble raising enough commodities. We had droughts. We had a few factors that involved that the whole world did not have enough supply that made them comfortable of wheat and corn. Mm-hmm. We had a tremendous rally, and that was also the rise of the ethanol. And so a lot of corn was getting consumed by ethanol. And we had a huge jump in corn prices. We went from $1.80 to $3. We jumped up to $7 corn within just a couple of years. It's a cycle, and they feel like that cycle is going to emerge again, and probably at a stronger rate because of the growth of the world economies and the middle class, and just demand for food.
Yeah,
and the world's producing less and less. I'm very optimistic about the agriculture industry.
It sounds it, and I like that. I like that because right now, I mean, and this is probably a good segue, quite honestly, in the, you know, one of the last topics, second to last, I guess, Monday. You know, I know that I was talking with my girlfriend on Sunday and was sort of watching the overnight activity, and it's like every 5 minutes I would watch the S&P tumble another 10 handles, and it was, you know, for me, when I first started trading in November of 2008, that was the only thing that I saw. So this was a blast from the past a little bit, brought me back to when I first started. You know, in that exceptionally volatile time in November 2008. Well, from a physical standpoint, and you know, from the way that you use financial products to sort of work with your farming, do days like last Thursday, last Friday, Monday, Tuesday, and today, does this past week does this scare you at all? Does it sort of bring a little bit of unease with, you know, your specific market? And is it something that you actually utilize? Would you utilize this last week in stocks, equities, and bonds? Would you utilize what's going on in those markets and sort of push it to your market as well to make a long-term judgment call?
No.
I expected that answer. I really did. I expected that answer.
What I really try to do is I keep it simple. I specifically look at the technicals and the fundamentals of each commodity that I'm trading, and I already have specific price points I can live with, and I just track those markets. And I used to try to analyze so much more and have a translation of it, and it would drive me insane.
Yeah.
I guess the other way is that I try to set back, and I really, with a corn trade or my wheat trade, if I take a position, it's probably 3 to 4 times a year, and that's it. Now, this last week, there was a reaction. There was a spillover to the commodity market. Things went lower again, and I wasn't expecting it. I bought back in on the board on my wheat. I'm speculating some of my wheat because my bias is we are at the bottom.
Yeah.
So we repositioned a bunch of corn and more wheat yesterday and today.
Okay.
And we retook ownership on the board. We bought back in on the board, and
wow.
Expecting this to rise. Now my wheat I put on March of 16. I think this is going to be a slow run. I do think there's a
curve up for that. So quick. Keep talking. I'm just going to see if I can get that up.
So we already have future positions on majority of our crop. So we're just putting it back in there and trying to add some more value to what we're already positioned at.
Yeah.
I like to take odd numbers. 17-cent gain. I'll live with it. I'll get back out.
Yeah.
Apply it to my portfolio. I never look for round numbers. I never do 20 cents, 25, 30 cents. I feel like the market usually misses me when I do that.
Yeah. I can understand that. Yeah. So you said March at what? March of 2016, you said?
Yeah, on wheat. On wheat.
Right.
Wheat.
Yeah, we've got wheat up. So you're going to ride that, that sort of contango curve that we're seeing as it continues to move higher.
Yep.
Awesome. Are there any, do you trade spreads by any chance, or are you looking primarily just at the outright product with what you produce on the physical side of things?
Just the outright product.
The outright product.
Yeah. We're gambling enough trying to raise it, and we're betting on the weather. We don't have irrigation. We don't water our crops, so we're counting on Mother Nature to rain on it.
Yeah.
So we're gambling on the weather and on the markets.
I'll tell you what, you're a braver guy than I am. I wouldn't be doing that.
So I don't trade any spreads on the commodities we're taking in.
Yeah, yeah. And I gotta, I have a chart up of wheat over the same time period that we were sort of looking at oil, and I'm gonna try to push it out a little more even and do it on a weekly time frame because it's really interesting. We really are in a spot where it's prosperous, like you were saying before we sort of went live, where we see that much larger upside potential than we do a downside potential. And yeah, I mean that's a pretty convincing chart, as long as it doesn't go lower, I guess. As everybody always says, it works until it doesn't. But it's like, yeah. I mean, and when it's this is sort of what we were discussing in 2007 too, that monster run up, and then we had that large collapse. In a price situation like that, both now that I'm looking at this chart, from a physical standpoint and from how to hedge yourself, when prices get to that level that quickly, in a year to 2 years time, you go from 400, 450 to 1340, 1350. How do you and then back down, really? How do you handle a swing like that? I mean, that looks insane from a physical, from a commercial standpoint. I can't really even wrap my mind about that, how you sort of hedge yourself in a parabolic market that then, continues and just falls and collapses back down to price.
Well, especially take the perspective of prior to that rise. That trend was much more steady. So to have that big rally was so mind-boggling because we'd never seen it before. You didn't know how to react to it and whether it was going to continue forever, or, you know, and since then, that was a big lesson, I think, to a lot of us that high highs never stay high.
Yeah.
But you create opportunities. In '08, that's when the hedge funds really started getting involved as well in the commodity markets. There was a point, if you took the same chart, you would have if you took the corn chart and put it on there, it would be a similar rally. And there was a hedge fund, the Teachers Hedge Fund of California, had a 7% holding in the corn market, and they held more corn and paper than the U.S. had in total production that year. So,
oh my gosh, it's like who are the brothers that cornered the steel market or the silver market? That's all I can think of with that. That's ridiculous.
So, what it has done since that time period is it's made me realize that there's always going to be a pricing opportunity, but you better have your number in front of you. And we do that all the time. I'll call my trader, the person that took my position here, and let them know that these are my price points. Just put them out there as offers on the futures. Most of the time we fill on the overnights. There's a lot more activity, and we fill in those positions on the overnights. As a producer, I need to know what my bottom line is, what I'm going to raise, an estimate, what it's costing me to do that. At that point, anytime there's a price point above that, I take it. I don't care how much higher the markets go. I have my own grain elevator that I store my own grain in. And we'll get down to the last couple semi-loads before we actually sell at a very high point in the market. Our goal, my marketing goal, is just to make, in a marketing season, a growing season, to make the top third. And that's a pretty difficult
it's a goal. Yeah,
it's a heck of a goal. We typically make the top 50, and a lot of it has to do with the advisory services that I do use and their input. And I love to technically trade, love the technical.
Yep.
And the hedge funds do too, and that's what makes it even easier. They're watching the technicals as well, and that's their. And so that
I guess for another thing that I wanted to ask, and then we'll sort of discuss a little bit about, you know, sort of the future of the futures markets as a whole. You mentioned the hedge funds, which is kind of interesting. You know, sometimes speculators and commercial guys sort of, if you're looking at the Commitment of Traders report that comes out every Friday, you know, I look at it from time to time because it's a little bit backdated. I haven't really looked at it much from this down run in the energy markets, just because it is old data. And I already know that Bloomberg is going to report the headline as it is, so I'm not going to look through it myself. But you know, it's sometimes they mix and match. You know, sometimes the commercial guys are inverse of what the speculators are doing, and vice versa. You know, do you see an inverse relationship with ags, with commercial versus speculation, and the hedge fund guys and the guys that are getting into, you know, spread opportunities, or do you see them be, you know, in inverse as well? Do you see them sort of act opposite of each other, or are they, you know, sort of positioning themselves in the same direction?
Opposite. And then you got the producer running right through the middle, missing the boat on both ends every time.
Poor guy. That's brutal.
No, there's definitely an inverse. It'll chart out as a complete inverse between your commercials and your end users.
Yeah. I figured that was you know, sort of a going trend with ags. I know energy, it's pretty much always inverse. So
yeah.
So yeah, I mean, with your experience, and we you know, sort of wrap us up with this question, with your experience with all the product development that you did, and you know, the changes that you've sort of seen over the last 25 years of what you've been doing, from, you know, the farming side of things, the financial instrument side of things, you know, working with Cargill, being independent, you know, where do you see this, you know, the future of the futures markets, and where do you see sort of the future of farming as a whole, you know, from the technology standpoint of things, you know, in the next, I shouldn't say 5 years, but maybe, you know, even longer down the road, maybe 7 or 10 years, you know, what's that long-term outlook like in the agriculture market?
The long-term outlook is going to be mind-boggling. Monsanto put it best. The company Monsanto,
Yep.
the chemical company, they had a presentation a couple of years ago. They said, all right, you take into perspective of what man has done in agriculture in the last 10,000 years, all that development. You can take any perspective you want, the genetics, the fertility, the farm machinery, GPS. What has occurred in the last 10,000 years, all that development and change will happen in the next 10 years.
Wow. Okay.
And it is happening exponentially. And it won't be any different with the futures market or any of the commodity trades. You're going to get to where you're going to get more and more people that are going to day trade commodities, just like they are stocks or anything else. I think they're going to find that there's a position they can use those as part of their portfolio. Mm-hmm. That creates volatility, it creates volume. It'll help us as a producer. The next thing is I really believe we're hitting that tipping point. We're bouncing in and out of it, that we're not producing enough food for the world. And it could be an interesting dynamic in the next 10 years. And then you just get right to the economics 101, supply and demand.
Yeah.
I feel like commodity prices are going to be tremendously strong in the long term, in the next 10 years. And with technology, our efficiencies are changing dramatically, as well as what we're doing just in the field. And the guys that are falling behind are going to fall behind very quickly. And I think you're going to see a huge consolidation of farms throughout the U.S.
Really?
And it won't be, you know, you hear the corporate farm.
Yeah.
It's no different. Yeah. We, if in the where we're located, I mean, we're not like the Midwest, where our acreage is so much more highly productive.
Yeah.
In the USDA's statistics, my farm operation is considered the top 1% in the nation.
Really?
Yet it's just my family, and I support 3 other families that work for me.
Yeah.
And we're considered one of the big corporates. But in our plan for our operation, we feel like right now we're at a 20,000 acre operation. To survive, to hand this down to my kids and be competitive in the market.
Yep.
We need to double in size in the next 10 years.
Really? Really? Wow. And is that primarily because of other competition coming in, or is that because producing more to sort of counterbalance what's going on with that economics 101 conversation?
Similar, yeah. And it's like in the industry, everybody's margins are getting tighter and tighter to be competitive, and everybody's consolidating to be more competitive. And there's a lot more diversification, and we got to look at that as well, raising a lot different, many more commodities, and being more diverse both in the markets and with the weather. The other thing is the people we're selling our commodities to, and we're buying our products from, like John Deere. John Deere has consolidated their dealerships nationwide. To be a player, you got to be buying $17 million worth of equipment to get any kind of discount on farm machine.
Wow.
You have to be bigger and bigger to be able to be in those competitive edges. Cargill, they're interested in buying train loads, unit loads of grain from us, which is 330,000 bushels.
Yeah.
And you're going to get a 40-cent increase in your bottom line. You got to grow.
Yeah.
You got to be big to survive, I think. That's my personal belief, and that's our operations goal.
So, and to sort of, you know, like kind of wrap it all in here, with regard to that growth, do you see this being just a pocketed U.S. thing, or do you see this sort of spreading out to the Latin American countries? Do you see this spreading out to, the Asias and the Indias? Do you see it going anywhere else, or do you see this primarily staying landlocked as a phenomenal opportunity here in the States to sort of take advantage of this particular market right now?
South America's got more potential than any continent right now.
Really?
Increased ag production. And they're actually going to surpass the U.S. in the next year or two on soybean production.
Really?
And they're a long ways from ever competing with the U.S. in corn production, but they are definitely emerging very quickly. And
that's really interesting.
Competitor with the U.S., especially on the soybeans. They're a huge competitor with the U.S. China will knock on their door typically before the U.S. is for soybeans.
That's interesting. That's nuts. Well, I feel educated. I sufficiently learned a lot about the agriculture markets tonight, and again, sort of back it up a little bit. The reason, I sort of brought you on, and I talked about this on the phone when we first sort of had the conversation about getting you on here. It was like that. It was the broker commercial that I discussed with you, where the little kid's walking with his dad and is asking all of these questions, and he asked a very simple question that kind of catches his dad off guard. It's one of those thinking moments. I was out to dinner with my girlfriend, and I was talking to her about sort of the prices. This is a month ago. The prices of crude just absolutely getting manhandled. And she said, what if you can't trade that market anymore in 5 or 10 years? What if that market just disappears? Then that was like obviously a little far fetched. Crude oil is not going to disappear in 5 years, but it got me thinking. Like, that's really kind of an interesting question, and that was the second time that I got asked that week. It could have been just because everybody was thinking that the world was ending in that particular market, but for me, I was like, it sort of spurred my interest to get other people on that handle other markets from a commodity standpoint. And ags is, I grew up around farmland, so for me it was sort of something that hit home a little bit, and it was an interesting topic to sort of bring in. And I think you educated me, and I know that everybody else that watched tonight, you definitely educated them as well if they didn't know much about the ag market. So thanks for coming on. Appreciate it big time. We'll have this up, everybody. We'll have this up pretty much instantaneously. So I'll be posting it tomorrow, and I'll get it up on LinkedIn as well tomorrow night. But in the meantime, everybody enjoy. Scott, thanks again for coming on, man. Big time appreciate it.
Thanks, Zach. I feel like I bounced around a lot. There's so many details.
But, I was going to say, hey, that was good. That was good. We'll get you back on in the next quarter to get another sort of perspective on what's going on, and to see what kind of changes sort of we've experienced in the winter. And
good. We'll have harvest wrapped up, and then we'll have a much better perspective come December. So
good. I like it. We'll get you back on then.
Sounds good, Zach. Thanks,
awesome.
Buddy.
Thanks, Scott. Appreciate it.
All right. All right.
Goodbye.